The spreadsheet has been open for 11 hours. The model is supposed to hold. You work at a regional firm in Oslo, 4.2 billion under management. Nobody knows your name outside this floor. Tonight you stress test the fixed income sleeve against a 150 basis point rate shock. You have run this exact test 47 times before. Tonight is number 48. At 11:48 p.m., it does not hold. Something is fundamentally wrong with what you are looking at. The error is not yours. A senior manager named Erickson overrode a duration constraint and buried it inside a cell formatted to display as 0, 3 weeks hidden from any standard review. $340 million notional, leveraged exposure to long-dated Norwegian krone debt. The swaps assumed flat volatility in perpetuity. The hedge was decorative in every practical sense, completely useless against any real market movement. Then Norges Bank drops a surprise policy statement, an unexpectedly aggressive hiking path communicated without prior signal. The mark-to-market loss hits $61 million, and it is still moving in the wrong direction. You do not sleep. You open a blank sheet and build a second model from scratch. The second model confirms everything the first showed you. You build a third independently. All three reach the same conclusion without variation. At 12:15 a.m., you compose an encrypted message to your compliance officer. You press send before you can construct a reason to wait until morning. The message goes through cleanly. By 7 a.m., compliance has escalated the matter directly to the board without pause. The building shifts in a way you can feel without anyone saying anything directly to you. By noon, external auditors are present on your floor requesting files nobody had prepared in advance for their arrival. Erickson is placed on administrative leave before the afternoon ends. Nobody on the floor makes eye contact with you for the rest of the week. The position unwinds at a $47 million loss rather than $61 million. The market moved partially in your favor during the unwind. What the institution remembers when the dust settles is not the loss. What they remember is that you found it. You sent the message at 2:15 inches the morning when you could have waited and let someone else discover it in daylight. 3 weeks pass with the floor operating under a visible quiet. Erickson is gone permanently. You return to your desk and the work continues. Then your phone rings from a number you don't recognize. The man on the line is named Håkon Vestergaard. He has never worked anywhere that could be described as small. He works for the Government Petroleum Fund, $1.4 trillion under active management, an institution that owns approximately 1.5% of every publicly listed company on Earth. He tells you there is an opening in quantitative risk that he thinks you should be aware of. He says it with the casual tone of someone mentioning the weather. He tells you to think about it over the weekend before responding. That instruction alone tells you everything about how seriously you should take the call. You start on a Monday in January. New building, new badge, numbers of a completely different magnitude surrounding you from your first hour there. Your badge reads Analyst, Quantitative Risk. For 8 months, you are precisely and only that. You build factor models. You decompose portfolio variance across asset classes. You never touch the actual controls of anything. $800. Million decisions are made in the same conversational tone as choosing where to have lunch that afternoon. The numbers do not feel entirely real to you yet. $800 million still sounds like someone else's problem being discussed in a room you happen to be sitting in. What changes you first is not the size of the numbers at all. It is the patience embedded structurally into how this institution operates. This fund absorbs market events. It does not react to earnings misses or analyst rating changes or short-term sentiment cycles. It simply holds its positions through everything. The fund is so large that panic selling would itself move the markets it was trying to exit. Panic was therefore removed from the operating framework entirely as a structural matter. You learn for the first time what genuine capital permanence actually looks like when it has been built deliberately into an institution's DNA. Fear was architecturally eliminated here long before you arrived. 8 months in, you are still functioning as an analyst in title, but you are beginning to understand the machine beneath the surface of daily operations. You learn the way you have always learned what genuinely matters, slowly at first and then completely all at once. It is not fearlessness that makes this institution different from every other place you have worked. Fear simply never had a structural home here to grow from. Markets open and close. Crises ignite and eventually fade into history. The fund continues without visible disruption to its fundamental rhythm. You are still carrying the analyst title, but something permanent in how you understand and relate to money has already changed beneath the surface. By year 3, you are no longer functioning as an analyst in any meaningful sense, even if the formal transition takes time to catch up. You are present in the room when major allocations are being decided by the people who actually control them. Not yet at the table in any participatory way, still positioned along the wall observing, but you see clearly for the first time how decisions of this magnitude are actually reached in practice. Nothing about the process resembles what you studied carefully in graduate school. It is political in ways that surprised you initially. Every number presented in that room has a specific relationship standing behind it. Every relationship carries its own accumulated history that shapes how the number is received. The head of equities is a Finnish woman named Pai Lahti. She controls allocation decisions across $620 billion in assets. She operates through a combination of absolute intellectual rigor and a complete willingness to make superiors visibly uncomfortable when the situation requires it. She terminated a $2.1 billion infrastructure allocation proposal alone in under 40 seconds during one meeting, you observed. Nobody in the room attempted to argue with her reasoning. The counterparty model had been constructed by the same consultant whose flawed framework contributed to destroying a Dutch pension fund in 2019. She had retained that information without being asked to and applied it precisely when it became relevant. She remembered every significant failure, every flawed model, every questionable relationship stretching back further than anyone else present in those rooms. You begin building your own archive in direct response to watching her operate. Every major deal the fund has considered, every consultant who has appeared before the investment committee, every risk model that was accepted or rejected, all indexed carefully across 3 notebooks filled across 3 months of concentrated work. Every observation you think might matter, recorded without filtering for what seems important today versus what might become important later. You keep the things nobody asked you to track, the institutional memory that lives only in specific context rather than in formal documentation. After 6 months sitting in that room, your analytical capabilities have been fundamentally restructured by sustained exposure to how decisions at this scale are actually made by people who have operated within them for decades. You cross-reference 7 years of fund records looking for patterns that haven't been formally cataloged anywhere. You find recurring patterns nobody had assembled into a coherent picture. You find names that had drifted out of active institutional awareness, but whose histories remained highly relevant to current decisions being made. The archive continues growing. The underlying pattern becomes progressively clearer to you with each edition. Then, one afternoon, Pai asks you a question directly and without preamble in front of the full room assembled for a committee meeting. You answer from memory, drawing on the archive, citing notes nobody had asked you to compile or maintain. Pai nods once and returns to the papers in front of her without further comment. You learn quickly that in this particular room, a single nod from her carries more weight than extended praise from anyone else present. After that afternoon, the room reorganizes itself in your perception. The table you are not yet sitting at feels meaningfully closer than it did that morning. You carry the full archive with you from that point forward, the fund's complete institutional memory, the names, the histories, all of it genuinely yours now, in a way that cannot be taken back. Year 5. Your title is Portfolio Strategist for Real Assets. You are no longer positioned along the wall, observing other people's decisions. The real asset sleeve you now help manage totals $74 billion across infrastructure, real estate, timberland, and unlisted equity holdings. These are not trades in any conventional sense of that word. You are acquiring structural positions in physical systems that will operate across decades regardless of what financial markets do around them. You take a 40% equity stake in a Chilean desalination consortium, providing critical water infrastructure to communities with no alternative supply. You take a long-duration ground lease on the Rotterdam Port Logistics Complex, with decades of contracted cash flows attached. You become a cornerstone investor in a Kenyan renewable energy developer, whose projects will represent approximately 18% of Kenya's national electricity grid by 2031. You expected to feel a form of power when these positions closed. Instead, you feel something you hadn't anticipated and have no clean word for. You feel implicated in outcomes you cannot fully trace or control. That is entirely new as a sensation. Power at this scale does not feel like power when you are actually inside it. It feels like a permanent obligation that cannot be set down or delegated away. On a Sunday morning, the Chilean consortium announces a water price increase affecting communities across 3 regions. An independent NGO publishes a detailed report within 48 hours. The report connects the price increase directly and explicitly to the structure of foreign institutional ownership. You read every word of it at your desk without skipping anything. Back in the office, you model the reputational risk exposure first, then the regulatory risk scenario, then the full replacement cost of unwinding the position if the situation escalates beyond the current level. The replacement cost of the position as structured comes to $2.3 billion. That is the number that ultimately governs what the fund can realistically do in response. You recommend a $14 million community investment program to be implemented across the affected regions over 3 years. The fund approves the allocation without extended debate. You are clear with yourself that this is not idealism driving the recommendation. It is risk management applied to a specific, identified exposure. You remain genuinely uncertain afterward, which framing is more honest about your actual motivation. The ideological framework you carried into this work when you arrived has been replaced over these years by something that operates more like continuous calibration, quieter than ideology, more durable in practice. Every position in the sleeve affects specific people living specific lives. The overwhelming majority of them will never know your name, or that the institution you represent has any claim on the infrastructure they depend on daily. You manage $74 billion with the same fundamental discipline you applied to 4.2 inches Oslo. The scale changed the instrument you are working with. The underlying question that governs every decision remained completely identical throughout. What is the actual risk here when you look past the surface presentation of the numbers? Year 5 closes. You are at the table now in every meeting that matters. You are also embedded inside every system your decisions touch in ways you cannot always trace or anticipate. Year 8. The call does not originate from inside the fund. It comes directly from the ministry. Minister Solberg offers you the deputy CIO position in a conversation that is structured as an offer but carries the tone of a decision that has already been made at a level above the conversation itself. You accept with the full awareness that genuine sleep will never be completely restored to what it was before this role. That is not a question you spend time examining. The CIO is a man named Thorvald, one of perhaps 3 or 4 people operating at this specific level anywhere in the world at any given time. You study him the way you once studied spreadsheets in Oslo late at night, looking for patterns, tolerances, and the specific locations of his blind spots. Capital at this scale moves through established relationships rather than through market mechanisms as conventionally understood. That is the first and most important lesson he communicates through his behavior, rather than through anything he says directly to you. You sit across from the CFO of a major global bank in a room negotiating the restructuring of $90 billion in Tier 1 capital requirements. You leave the table having extracted board observer rights, full fee transparency provisions, and the most aggressive ESG covenant ever successfully inserted into an agreement of this type with this counterparty. Their equity price rises 4% on anchor investor speculation before a single word of the agreement has been communicated publicly to anyone outside the negotiation. You manage the $4 trillion liquidity framework, with Thorvald making final decisions at a level you cannot yet fully follow in real time. You file every decision he makes that you don't immediately understand. You will reconstruct the reasoning later when the outcomes become visible. Sleep becomes a managed resource like any other input to the operation. You schedule it the way you schedule currency hedges, with discipline and without sentiment about what you would prefer. Your personal calls decrease to the level required to maintain the relationships that remain genuinely necessary. Your marriage compresses progressively into logistics and forward calendar management. You notice both of these changes happening with full awareness and without finding any practical path to reversing them at this stage. Personal cost at this level is not accidental or the result of poor choices made along the way. It is structural to the role itself. You accepted it implicitly when you took the call from Minister Solberg. You sign a $2.2 billion allocation in 5 minutes on a Tuesday afternoon. A billion has become a functional unit of measure rather than an abstract concept carrying any emotional weight. That transition is the most genuinely dangerous one you have made, more dangerous in its implications than any specific investment decision. You study Thorvald's decision latency with the same attention you gave to Pi Lati years earlier. How long before he moves on a given type of problem? What specific conditions cause him to slow down when his default is to move quickly? You are running the machine now in a way that is categorically different from watching it or studying it from a distance. Power at this level arrives as indistinguishable from the responsibility it carries. They present themselves as a single, unified object with no seam between them. Year 8 closes. Thorvald tells you something in a private conversation that he has communicated to nobody else inside this building. He gives 18 months formal notice of his intention to step down. Nobody outside the floor you share will know this information for the next 6 months while a process unfolds. The external candidate list assembled by the ministry is long and contains names you recognize and respect. You observe it get shortened methodically over several months as candidates remove themselves or are removed by others. The confirmation arrives in a 4-minute call from Minister Solberg on a Wednesday afternoon. 4 minutes for a decision of this consequence. You are now CIO. You control more capital than the gross domestic product of most countries that exist on Earth. You are 41 years old. There are 12 missed calls waiting on your personal phone when the call from the minister ends. Power does not arrive as the expansion of what is possible. It arrives as a progressive narrowing of options that were previously available to you. Every public appearance, every letter published under your name, every AGM vote the fund casts is parsed and analyzed globally by people with significant resources dedicated to understanding your intentions. You stop attending public conferences after the first year in the role. The signal generated by your consistent absence becomes its own form of communication that you learn to use with precision. You learn to distinguish genuine deliberation from paralysis in your own decision process. From the inside, they produce identical sensations and cannot be separated by feeling alone. The network that carried you to the CIO position contracts the moment you formally occupy it, following the same mechanical process at every level of this system. The number of people who can speak to you with genuine freedom and without agenda is fewer than 20 individuals. That number will continue declining as the role consolidates around you. You sign a $2.2 billion allocation without visible hesitation. The markets push back against the position in the weeks following. Amber warning indicators appear across the risk dashboard and remain there. You do not move toward panic. Every decision you make from this chair is observed simultaneously by the ministry above you, by institutional competitors analyzing your revealed preferences, and by markets that have already priced your presence into their models. The chair does not make your position permanent within the institution. It makes you permanently visible to every participant in the system. Those are not remotely the same condition. Your marriage operates now as a shared logistical infrastructure and a coordinated calendar. You both understand the arrangement that has developed. Neither of you has said so directly in a conversation. The illusion that you exert meaningful control over the broader market occasionally forms in your thinking when things go according to model. Then the market corrects it cleanly and without sentiment. You relearn the lesson that has been true since your first night in Oslo. The market does not concern itself with who occupies any particular chair. It never did at any scale. Year 1 as CIO closes without catastrophe of any kind. You understand after 12 months in the role that this outcome is itself a genuine achievement worth acknowledging, not a baseline expectation. A G20 economy enters a sovereign debt crisis in the second year of your tenure, illiquid in its current condition but structurally solvent when you examine the underlying fundamentals with the full resources available to you. The market has already priced a default scenario into the available instruments. The IMF support package is approximately 12 weeks from formal approval and deployment. You have $18 billion in undeployed capital from a strategic rebalancing that Thorvald had endorsed reluctantly 6 months before his departure, capital that sat uncomfortably on the sideline, while every model you ran kept pointing toward the same conclusion. You run the full scenario analysis across 4 consecutive days without stopping. Every model you build converges on the same distinction. The country is illiquid under current conditions, not insolvent in any structural sense. That distinction, properly understood and acted upon before the market recognizes it, is worth approximately $6.2 billion in recoverable value. You deploy $2.1 billion in the first tranche across sovereign bonds of a country the consensus has already written off publicly and positioned against. You deploy across 11 trading days total, 3 tranches, $6.2 billion committed without public announcement or market signal of any kind. Not enough capital to rescue the sovereign situation unilaterally. Precisely enough to signal that permanent capital, with genuine long-term perspective, sees recoverable value in a place where the market currently sees only accelerating ruin. Other institutional investors with similar mandates and similar time horizons observe the position building through mandatory disclosure mechanisms and begin to follow the signal without any direct communication from you. You said nothing publicly. The position communicated everything that needed to be communicated to the audience that could act on it. The IMF package finalizes on materially better terms than the early negotiations suggested were achievable. The country does not default. Yields reverse as the market reassesses the probability distribution it had been pricing. The position marks to market at plus $1.1 billion unrealized over the 14 months following initial deployment. No public statement is issued. No press release is prepared or released at any point. Formally acknowledging the outcome would require simultaneously acknowledging the full scale of what was moved and under what decision-making authority. The mandatory disclosure filing triggers a legal review initiated by the Ministry Council. The intervention is assessed as technically within the existing mandate parameters, but the scale and nature of the action requires formal parliamentary review to determine whether the current mandate framework remains adequate for the capabilities the institution has demonstrated. The word technically is doing significant structural work in that legal opinion. The review is framed as structural in nature rather than punitive toward any individual decision-maker. The central question being examined is whether the existing rules governing the fund's mandate remain adequate given what has now been demonstrated as operationally possible. The legal opinion arrives and is delivered to you on a Tuesday evening at your desk. Intervention within mandate, parliamentary review required, structural in nature, not punitive in intent. You set the document down on the desk and sit with it for a few minutes. Markets open in Tokyo in 4 hours and will open indifferent to the review, to the position, to the opinion, and to everything you have built or decided across the years that led to this chair. What you have demonstrated through this intervention is the precise outer boundary of what was possible under the existing framework. In demonstrating that boundary clearly, you have made it permanently less accessible to whoever sits in this chair after you. The next CIO will operate inside a mandate that has been explicitly narrowed by the parliamentary review your action necessitated. You made that constraint permanent by showing concretely what the unconstrained edge looked like. That is the reckoning that accompanies the outcome. Year 2 closes. The position continues to hold as modeled. The parliamentary review opens on the schedule announced. The rules that govern this institution begin the process of formal revision. You read the full legal opinion again on Tuesday evening before setting it aside. Parliamentary review, structural, not punitive in its framing or intent. Markets open in Tokyo in 4 hours from where you are sitting. $1.4 trillion. 9,228 companies distributed across 73 countries. Every one of them opens again tomorrow morning, indifferent to everything that has occurred in this building. The liquidity framework that governs how the fund operates rests on an assumption that no single market event will require simultaneous forced liquidation across 4 major asset classes at the same time. That assumption has held intact for 19 consecutive years without being seriously tested. You are not certain it holds permanently under all possible future conditions. The quantitative team flags a correlation breakdown developing in the real asset sleeve, a pattern first visible in data from 2017 that nobody flagged at the time as significant. The pattern reminds you of something specific without immediately being able to place exactly what. Then you place it. A spreadsheet. Oslo. 11:48 p.m. On a night years ago that now feels like a smaller and more manageable version of the life you were living. The scale changed everything that is visible about the work. The fundamental nature of the underlying risk question never changed at any point across the distance between that desk and this one.